Hello everyone. Today I'm going to explain accounting for share-based payments and I'm going to teach the pretty basic stuff, so we won't be going into detail about things, but it will be a less than 10-minute video, so here it goes. Now let's first understand that there is a timeline of events in this. So the first one is the grant date, and this is the date when the option is given by the company and accepted by the employees. The second one is the vesting date, and here it is the employees become entitled. So after a certain period of time, the employees are entitled to get those options that have been granted on the grant date. And the period that is between the grant date and the vesting date is known as the vesting period. Now there's the last one, and that is the exercise date. And this is the date when the employees will exercise the option. So on the vesting date, the employees are entitled to exercise the option, and on the exercise date, the employees actually exercise that option. All right. Now, let's see the various kinds of share-based payments. The first one is ESOP. It will be, and it is an abbreviation for Employee Stock Option Plan. And the second one is ESPP, that is the Employee Stock Purchase Plan. And the last one is SAR, that is the Stock Appreciation Rights. Right, and now there are various categories of the employee share-based payment plans, and they can be categorized in first, that is equity settled, second one is cash settled, and the third one is employee share-based payment plan with cash alternative. So that would be a hybrid of the first two. Now, as we saw three about types of share-based plan, that is ESOP, ESPP, and SAR. So ESOP and ESPP will be categorized under the equity settled plans, and SAR will be categorized under the cash settled plan. Now, first let's understand the ESOP. For accounting purposes, there are two kinds of valuation method for ESOP. The first one is intrinsic value. Now, what is this intrinsic value method? So, calculatively, that would only be the market value at the grant date of the option less exercise price. And the fair value will be the arm's length price less the exercise price. Now for the fair value method, we won't have to calculate the arm's length price and less the exercise price. Always the fair value will be given. All right. So what is this value, intrinsic value and this fair value? It is actually the amount of discount that the company gives to the employees. So basically, company forgoes a certain amount of premium when it issues an option. So the company has to account for the discount. So that is actually the foregoing of the premium every year during the vesting period. All right. So it won't actually go all in and recognize the complete expense at the vesting date. It has to amortize over the number of years that constitutes the vesting period. Alright, now let's see the basic accounting entries for this. We will be seeing it under the ESOP that we are currently doing. So the first one is employees compensation account to stock option outstanding account. Employees compensation account is the expense account. That is the amount of discount to be recognized each year. And the stock option outstanding account is the collection, is the account where the amount amortized every year will be collected. So it will be of course appearing in the balance sheet. The second entry is stock option outstanding account to general reserve account. Now the first entry that we saw will be passed every year during the vesting period. The second entry is passed on the vesting date, on the exercise date, and the second entry, stock option outstanding account to general reserve account, is for the amount that the employees have not taken the option, have not exercised the option. So the amount has to be reversed back, and the provision that was created during the vesting period will be reversed to the general reserve account. The third one is also to be passed on the exercise date, and it is a stock option outstanding account to equity shares account to securities premium account. So that is the issue of the equity shares. Okay, so the basic construction of this employee stock option plan would be that the company will be issuing the options to the employees on the grant date, and it will issue a certain condition that the employee has to, say for example, he has to continuously be in employment with the company for say 3 years. So at the end of 3 years, the employee will become entitled for the shares. So that will be considered as the vesting date. To understand employee stock purchase plan, the employees are to make the decision at the grant date whether or not they will exercise the option or not. The exercise price is set at a certain discount rate of market price prevailing at the exercise date. So the employees will be given a certain market discount rate that they will be allowed to exercise on the exercise date. All right. So the discount is not fixed at the beginning, like in the employee stock option plan. Moving on to a subtopic, that is modifications. Modification means that a modification is made to the fair value during the vesting period, and two possibilities are we can anticipate two possibilities. So one would be reduction in fair value, and the other one is increase in fair value. When the fair value reduces, ignore, there will be no entries. When the fair value increases, there will be again two possibilities we can anticipate, that one will be during the vesting period, and the second will be after the vesting period. If the modification happens during the vesting period, we have to amortize the expense of the increase over the remaining period. It is on the exercise after the vesting period, the expense will be recognized immediately. Okay. Now, the amount that will be recognized as the modification value will be the revised fair value minus the fair value on the date of revision. Now, to be noted that it is not the date, fair value on the date of granting date, and it is the fair value that is prevailing on the revision date. Alright, now let's come to the next category, that is the cash settle. And the only option issued here is the stock appreciation right. Now the SAR is just like the ESOP, except that the cash is paid to the employees at the end of the vesting period, and fair value is revised at the end of every year, unlike ESOP where the fair value is decided on the granting date. Alright, now coming to the basic general entries, it will be employee compensation account to provision for SAR account, and just like the ESOP, employee compensation account is an expense account and the provision will appear in the balance sheet. So the only change is that stock option outstanding account gets replaced by the provision for SAR account. Now the last category, ESBP with cash alternative. Now this is the hybrid of cash alternative and the equity. So here this equity component will be separated from the cash component. The expense recognized based on the fair value is revised every year, meaning the fair value at the end of each year is to be considered to calculate expense under the cash component. So that will be just like the SAR. I will be explaining only this part for the ESPP with cash alternative. For detail, you will have to refer to the modules. Now let's have a quick revision. There's a timeline of event, 3 dates: grant date, vesting date, and the exercise date. The period between the exercise grant date and the vesting date is known as the vesting period. Three types of share-based payments or share-based payment plans: ESOP, ESPP, and SAR. And they can be categorized as follows: ESPP and ESOP will be categorized under the equity settled plan, and the SAR will be categorized under the cash settled plan. My aim was to explain this chapter in less than 10 minutes.